with Stuart Sinclair, who is a non-executive director of Lloyds Bank, one of the biggest banks in the world. He was formerly a non-executive director of TSB banking group, of LV Insurance, and of the banking group Virgin Direct. He's also a council member of the Chatham House think tank in the UK. He also, in the past, worked for Royal Bank of Scotland, where he was director of UK retail banking. There are several other high-profile positions and institutions that he's worked with. And when I spoke to him at breakfast this morning and asked him which his favourite job out of all of those was, he said, well, actually, it wasn't any of those, that his favourite job was when he worked in an ice cream store in Detroit. So I'm intrigued by that. And so rather than me speaking any more, I look forward to hearing what Stuart Sinclair has to say about governance and ice cream.
Thank you very much, Andrew, for that lovely introduction. I'll probably go more on the governance than the ice cream today, but I'm happy to talk to anybody about, it was actually a truck I drove, I wasn't working in the shop. But you know, the funny thing is, when you're an ice cream man, the great thing is every customer contact results in delight. No complaints, no problems, everyone's happy to see you every day. And honestly, there aren't many jobs like that in the world. So at least I haven't found them. And so it's actually quite nice to have such a role. But thanks, Andrew. And I also want to say a huge thank you to Walid, whom I've known for decades, for bringing me here. I'm so happy to be here in Istanbul. We met in New York last 2 years ago, and he said, I'd really like to come and have you speak at my conference. And of course, we've been delayed and delayed, so I'm thrilled finally to be here. Can I just say one other preliminary thing, which is everything I say, I'm saying in a personal capacity. I'm not here to represent Lloyds Banking Group. I'm not here to represent any of the boards I sit on. I'm also chairman of Willis Limited, which is part of Willis Towers Watson, and I'm the chairman of a company called International Personal Finance, which provides lending in 11 countries, from Mexico to Poland to Romania to Lithuania, Estonia, and so on. But this is just Stuart talking today. I'm not speaking on behalf of any of those people. So governance and finance, I know for some people, that sounds a little bit dull, and people will say, oh, this is great, I can catch up on my emails. And I can see many of you already are taking advantage of that opportunity. But actually, governance in banks and insurance companies and non-bank financial institutions and central banks is pretty interesting, intellectually quite challenging, and it grapples with increasingly big questions, some of which we saw this morning, very beautifully illustrated, I thought, by the Ali Bank presentation, and also by the panel members here talking about what's going on in UAE, what's going on in Turkey. It makes you realize people like us all over the world are grappling with an increasingly large and complex set of questions. And none of us, for sure, has all of the answers. But it's quite interesting just to think out loud about the list. So what I'm going to do first is offer you my list of perhaps 5 aspects of governance, which particularly come from a UK perspective, but which I think are quite widespread, based on what we've heard already today. And then I've got 9 recommendations. And I'm sorry it's such a big number, but I couldn't get it below the number 9. But these are recommendations on what I would be doing if I was the chair or a non-exec director, or indeed an executive in a bank or an insurance company, an asset management company, or anybody in our industry. Obviously, different jurisdictions are moving at different paces. I mean, it's quite interesting. I mentioned Poland and Hungary. These countries have regulators who increasingly are interested in total cost of credit caps, rate caps. In other countries, that's considered total anathema, and the regulator doesn't want to be a price regulator at all. But you do see from time to time different countries going to different places. So let me start with the first theme, which is I think the governance expectations of boards are changing quite a lot. And the reason I say that is that there's much more emphasis on values. And what do I mean by values? Let's face it, values means something different to each of us in this room. But really, values has to do with an expectation that regulation will be carried out both in the spirit as well as the letter. Not just, did we comply with the absolute detail of the regulation, and we have had interesting presentations on compliance this morning, but also the spirit of it. Like, did you actually get what we wanted you to be doing? And I think what each of us has to ask ourselves is, if you put yourselves in the foot of the customer, or the regulator, or the shareholders, are you seeing things being done which make you comfortable? And can you evidence that you have been through a sensible process of deliberation that justifies the decision you've come to? The funny thing about the word evidence is that in English it used to be a noun, and now it's a verb. You must evidence your thinking, and you must evidence the board's deliberations. And this is increasingly a big theme which I see, that you have to show that you've thought in a reasonable way about the decisions you're taking. And I think nowadays it's very hard to hide behind the absolute of a rule and say, oh, we absolutely were in the letter of the law or the regulation, because there's an overlay that there should be some sort of reasonableness test in addition. Another dimension of all of this is that the interests of all stakeholders have to be taken into account. Now, we saw that wonderful slide of Milton Friedman in the last presentation, and we all know Friedman was saying, look, capitalism works best if companies basically pursue shareholder value. And there is an argument to be made that that is a reasonable point of view. But increasingly, I'm seeing regulators saying, no, I don't really want that. I want to see that where all the decisions you make are made with regard to the interests of other parts of society, your employees, shareholders, customers, the environment, and so on. And so boards find themselves with a very busy agenda all of a sudden, not just deciding, you know, what new mortgage products do we want to have in the next 5 years, which cloud partner do we move to, but for every one of these significant decisions, what are the manifestations of these decisions on a lot of other people? And I'll come back to talk about that a little bit in more detail with regard to remuneration in a second. Now, this reasonableness mindset I think is quite interesting. Another way of putting it is to say, how do our decisions look to ordinary people? For example, if you've got a life insurance product or car insurance or something of that kind, and you say, well, the law or our terms and conditions say if you die at a particular point or age, the policy lapses. And that may be what the terms and conditions, which are often 40 pages of dense print, say now. But if you put yourself in the shoes of the customer, many of whom may be vulnerable or low income or not understand money very well, is that a reasonable decision? And you know, that starts to get very complicated very quickly, because if you're not careful, you can boil away the profitability of a company very fast if you take a pure consumer point of view every time, rather than a pure producer point of view. And so there's a little bit of intellectual gymnastics required to ground yourself in a newer set of principles about what is fair and reasonable, as well as commercially smart. And what I'm seeing on boards is actually, this is taking up a lot of time, because it's not obvious, even to clever people, how we're going to proceed with all of that. Colleagues have something to say about this. It's difficult to attract really great people, it seems. People like my children who are in their 20s have a lot of choice. And one of their criteria, increasingly, at least according to surveys, is, do I want to work in a company where I don't really feel good about their purpose, or I'm not convinced they're doing good things for society more broadly? And I think if we wish, as a company, to keep attracting and retaining talented younger people, we have to be able to demonstrate a purpose or a reason for being, which again was mentioned in those lovely slides from Ali Bank this morning, which they find compelling. Yes, the salary is important. Yes, meeting interesting colleagues is important, because actually a lot of people end up marrying their colleagues these days because they don't have any time at home. But this purpose thing is increasingly quite important. Let me go on to a couple of other things. Customer orientation is an umbrella term I would use to describe these thoughts. Number one, focus on outcomes, not process. You may have a process that sets, let's say, the prices of credit cards in a particular way, but increasingly, I think regulators around the world are saying, okay, but what was the outcome? On the poorest 10% of your customer base, what was the consequence of your decisions on pricing, fees, forbearance, the way you did collections, and so on? Because your intent is one thing, but when it cascades down to the real world, are you still proud of what you're doing? And you have to think about that commercially and morally. Again, as I said earlier, taking us into slightly unfamiliar territory. Similar questions would be, does the customer really understand what they bought? I mean, frankly, even in a relatively developed country like the UK, most customers have no concept of compound arithmetic. They don't understand APR, they don't understand the things which are our bread and butter, and they have no particular interest in understanding them. I mean, countless people have created charities for financial education. Customers just don't want to know. They just want the fridge, the car, the house, primarily. I know I'm generalizing. And the mechanics of finance just bore them. So there has to be a better way of figuring out how to empower the consumer to make better decisions. And this is a regulatory task increasingly. In fact, in Britain, it's a statutory requirement. It comes from the House of Commons to the regulator, to the banks, to say you must do everything you can when you are regulating banks to be sure that the customer is actually not disadvantaged by the products and the explanation of those products in the market. This brings me on to another theme, which is what increasingly we call duty of care, which is if you offer a product to somebody, is it going to stay fair and relevant throughout the life of the product, not just the day they chose to buy it? And that takes you into quite deep water. How are you going to test the suitability of the product after 2 years, when perhaps in a family one of the members has died or lost their job or moved or something? Are you really saying to us, regulator, you want us to almost real-time test the relevance of the product throughout the lifetime of the product and the customer? There is a hint of this at work just now, and we will have to figure out what does that really mean and how can we grapple with that. You know, in the spirit, I used the word spirit earlier, in the spirit of saying we get the idea that the customer should never be disadvantaged, but it's actually not obvious how we can continually test that the product remains suitable for the customer over a period of some years. It could be particularly difficult, let's say, in life insurance, where somebody takes the thing out, but perhaps family circumstance has changed considerably 3 or 5 years later. Now, interestingly, I think part of the puzzle here is a thing which I'm sure you all have called the Product Governance Forum. It's a group of functional experts who will get together to say, right, what's our idea? Does it stand up commercially? But does it also stand up based on the kinds of criteria I've been talking about? We all know intuitively the sort of things I've been saying, but it's useful, I think, to codify them in a forum which meets explicitly for this purpose, to say, have we actually considered this from 360 degrees rather than we've got a gap in the P&L, let's fix it with this product. Again, it takes a lot of clever people to think about how to do that right, and I have been a witness or a participant in many product governance forums, actually in a number of countries, and it's not as straightforward as I thought initially it would be. Let me move from sort of consumer regulation to prudential, which is more perhaps our natural area, thinking about capital and liquidity and so on. I think there's a couple of interesting new areas. One, which was already mentioned today, is environmental stress testing. Now, insurance companies, because of Basel II, are very used to having to do stress tests based on CAT modeling, as it's called, you know, the modeling of catastrophes and how that impacts capital. But for banking, it's relatively new. CAT models help, But boards and executives are increasingly grappling with, what is the right way to frame that question? Is it about who we lend to, e.g. coal mines, oil companies? Is it about how our capital base or our liquidity could be harmed in some way by environmental catastrophe, like flooding or fire? Or is it all of that and even more things on top? I think the trick for non-executive directors and execs is to say we can't have all of this complexity going on, we'll fry our brains. So how do we synthesize and collapse to a manageable amount of complexity, which we can then evidence, again, that word, to the regulator that we have thought about this, because there is no alternative. You must show you have thought about regulatory impact, at the same time as we feel the board members are equipped to understand it. I'm not sure about the situation in all of your countries, but certainly in the UK, non-execs are examined maybe every 6-9 months by regulators to be sure they have at least a reasonable grasp on some of these questions. You might say that's fair enough, we get paid to do it, but the stringency of the questioning and the level of expectation is going up and up and up. So I think it's becoming a tougher job, actually. Another dimension here under prudential regulation would be what's called operational resilience. Now, that was mentioned on the panel this morning. I think it requires, excuse me a second, requires people at a very senior level who 10 years ago might have said, I'm so senior, that doesn't worry me. Now, you have to worry about it. You have to be able to express what are the major customer-facing processes, what are the risks that could collapse them, what's the turnaround time to fix them, and what would be the impact on a customer if, for example, they can't go to an ATM for 2 days, or I'm not able to take complaints, phone calls, or things of that kind. And this operational resilience is, in the UK anyway, a statutory requirement now. There is a threshold of proof which will be required, the ultimate test not being until 2025, but boards are scrambling right now to hire consultants to help them frame and figure out their answer to this question on operational resilience. Another interesting thing about non-execs and senior execs is justification and understanding of technological choice. I remember 4 years ago, people from our two regulators, who are called the PRA and the FCA, coming to interview me on cloud. Why have you decided what's called on-prem, in other words, keeping things in-house largely, versus cloud is the right decision? What was the governance that you went through to arrive at that decision? How did you choose your partner? Are you going with Microsoft, whoever? I mean, there's only like 4 choices, but how did you choose them? How will you be sure cybersecurity is better now than it used to be? How will you be sure there isn't customer detriment from your choice? And so on. Now, I think this is a great example of an area where 5 years ago, 10 years ago, non-executive directors and the CEO, CFO might have said, look, that's IT stuff. I'm not bothered about it. It doesn't interest me. It's not my job. And now the regulators, increasingly, in my view, are saying it is your job. You must know about this, and you must be able to prove to us, if you wish to retain your license as a bank or your license as a director, that you have some familiarity with this. Not so much maybe the technical decisions, but the governance over those technical decisions. So again, I think the job's getting harder, but you could argue more interesting, because one has to learn about things which maybe, if you were slightly lazy 5 years ago, you could have just ignored. So those technological choices are becoming more complex and interesting. And then the final thing I'd say before I end the first half is just to talk about inequality, gender pay ratios, things like that, which remuneration committees have to think about. When I first joined a remuneration committee, which was maybe 12 years ago, basically, although it was dressed up, it was how much do we pay the CEO? That was the question. That's why the committee was there. It has a totally different agenda now, of which paying the CEO is a very, very small part. and it's more to do with how do we think about the interests of all our colleagues? How will our pay be perceived by society at large? Newspapers are very keen to report on highly paid bankers. Are we running a risk of that being a problem if we do this or that? And so the remit, even of that one committee inside the board, is wider and more demanding, I think. And allied to that is the question, keep showing us that your company is contributing to the good society through how you pay your colleagues, particularly the lowest paid ones, and through the other actions which you're choosing. So it's kind of a busy agenda. And I thought maybe I would finish by saying, so what do we do differently? Because frankly, this could overwhelm people. It could overwhelm individuals like me. It could overwhelm boards, senior execs, and so on. How do you kind of make sense of it? Well, I'm not sure I know the full answer, but I'm going to offer you 9 little pieces or fragments which may contribute to the solution. And some of them are very basic sounding, but actually quite tricky to do. And the first one is the most basic of all, which is keep records clean. And what I mean by that is throughout the customer journey, whether it's a commercial customer or a retail customer, have a clean file of the approach by the customer, the decision-making process, how things were decided, and so on. Because one day, for sure, you will have to go and look for that file when there's a complaint or when a regulator or a newspaper says, we will look at the last 100 complaints you have received and we'll make a big fuss if you can't explain, I found the record, I'm proud of the decision we took and the process we went through. If you're in a mess, you're going to waste an awful lot of money reconstructing those records, or even finding which warehouse they're in, if they're still paper, or where in the cloud they may have been filed. So that's incredibly basic, but you know, I'm always surprised at how often overlooked that fundamental task is. Next is another really, really basic thing. About 3 years ago, I was approached by this very clever guy from Austria who said, I would really like you to be involved in my company. And I said, yeah, okay, what does it do? And he said, well, we do reconciliation of data. And I thought, that sounds really dull. But as I got into it, I found myself believing this is actually fundamental to life. This company helps banks, insurance companies, and so on, reconcile files. So for a simple example, you know, I could be known as Stuart Sinclair. I could be known as Mr. S. Sinclair. I could be known as Stuart W. Sinclair. It's the same person. But of the, 300 entities I've dealt with in my whole life, to get a driving license, a passport, a bank account at Wells Fargo, a bank account over here, everyone's probably got a different concept of me. And somehow there has to be a reconciliation of parts of that in order to make sense of my asset holding, et cetera, et cetera. And this little company called Duco, D-U-C-O, which I have to confess and admit I'm a small shareholder in, does that kind of work for huge asset management firms like State Street Bank, and increasingly for JP Morgan, et cetera, because it's just very difficult to do it well. And what you find is huge files are sent to India overnight, Singapore. They're run against one another, but the failure rate is high. In other words, the matching ratio is low. And you might say, what has this got to do with banking and governance? It's got everything to do with it, because if you don't have clean data, everything else is going to be a mess and expensive, slow, embarrassing. And little firms like that, which isn't actually so small anymore, are trying to nibble away at these underpinning transactional level problems which have to be fixed. And a good board will know that that's an aspect of life, living cleanly through your data. And the board will be saying, what are you doing about reconciliation? Just give us 10 minutes on which vendors you use, why you chose them, are they any good? Makes life more interesting, I think. I think number 3, keep alert to all of this stuff. I mean, the fact that you're here today or listening in through the streaming suggests you are interested in what's going on. I think it's essential to keep doing that, because you've got to have the windows open to know what is going on. And there, you know, there's this blizzard of innovation in the world. Impossible to understand it all. It's very important that at least we attempt to know and filter What is there out there in terms of thinking, innovation, technical change that could be useful for us? So that would be number 3. I think 4 is ensure all functions realize they will probably be subject to regulatory scrutiny. For years and years, a lot of functions in a bank, let's say, would say, well, it's not going to happen to me, but it will. For example, look at the risk team building scorecards. Scorecards used to be a secret black box, as we say in English, where clever statisticians would run regressions, tests, champion-challenger activity to figure out the correct way to lend on a personal loan, a mortgage, what have you. Nowadays, what I'm seeing is regulators are saying, we want to test your scorecards, and we want to understand the governance of your modeling. Now, in a large bank, you could easily have 1,000 models run every day for different tasks. The question is, who actually gets to oversee that? Can anybody just go in and change things? Can they change the parameters, change the data, adapt the interpretation? Well, regulators are saying, no, that's not good enough. We think that could lead to unfair outcomes. So you'd better be ready for us to examine the governance of how you build and maintain your scorecards. And again, it's another small example of how more intrusive the regulators are and how, arguably, that's a good thing for all of us. We just have to be prepared and willing to field an appropriate level of exec and non-exec person to anticipate and deal with those requests. So model governance, I think, is coming our way. It's already arrived, obviously, in some areas, but I think it will become quite comprehensive in future. Number 5, I think making regulatory meetings educational events. Now, I've found working in the United States, where I've lived for about 14 years, often when a regulator visits a firm, lawyers come in and it's a confrontational meeting right from the start. I think this is totally unproductive. It should be an educational meeting. The fact is, in many countries I know, regulators turn over quite often. They may only regulate you for 2 years or 3 years. Every time a new team comes in, you have to explain to them, what do you do? How do you make money? How are you sure you're doing a good thing for customers? So I've always said to people, you have to put the hat on called education and listening rather than defense. And I think this is a very important mindset, which I think older people with a lot of experience on boards maybe haven't seen, but I see younger people willing to take up that attitude. And I think it's quite important because you're not going to win if it's a gladiatorial contest. They're the regulator. They can take away your license or impair your ability to make money. So it's important to have an educational mindset. I think number 6 is do be sure at least some of the board members, and maybe even in some companies the CEO, have strong recent experience in regulation. Because as you can see from everything we've heard this morning, and the things I'm saying, it is a central fact of life. There's no point wasting energy fighting it or complaining. It's here. So let's learn to maximize within that framework, and that often does require a little bit of experience and sophistication in how to do it. Okay, number 7, Product Governance Forum. I've talked about that already, but you know, it's a great way to bring a lot of this thinking together. So I would encourage you to visit, if you possibly can, other companies' Product Governance Forum. Now, they may say, whoa, that's way too dangerous. We're not going to open up the tent for you to see. But I have visited a number, partly when I did management consulting, but more recently as a non-exec. And it's very, very informative. I think it's a great, in fact, maybe your firm, Walid, should do some kind of benchmark of how good are companies at doing product governance. Because everything I'm talking about today is kind of to the question, when all of the expertise of the bank is brought to bear and the customer touches that thing for the first time, are we happy that the customer is getting a good experience? So I would encourage people to invest time in doing such a thing. Now, I said there was 9, but I actually changed my mind during the course of speaking, so I'm only going to do 8, right? And the 8th one is maybe the most difficult of all, and it's a change which comes slowly in big established companies. And it's what the organization design people call ownership. And by ownership, what they mean and what I mean is making sure you have executives, it's really more an executive thing than a non-executive thing, willing to see a problem and put their hand up and say, wait a minute, that's not good enough. I will own the task of leading a group of people to fix it. Whereas the traditional approach, frankly, in banking, in my experience, and I think a lot of inquiries have confirmed this, is to say, yeah, it was a committee. I wasn't involved. It was a different group of people that should really have done this, or I was too busy, I delegated it. I think those days are over. And the senior manager regime, which is what it's called in the UK, I think has versions in many of your countries where an individual is named as the person who owns a particular function or an outcome or a task. I think it's a big change of culture in many banks, actually, because even if you don't have formally a senior manager regime, you should be wanting, because of the ethical things I've talked about today, the desire to do the right thing for customers, you should want people who almost see it as a career building step to see something and say, you know, there's a better way to do that. I would like to take on that task. It may not be my formal job description, but I know we can do it better, and I'm going to own that. And I think this, perhaps of all the things I see in banks that we don't have enough of, because we have often plenty of capital, plenty of liquidity, plenty of lawyers, plenty of this, plenty of that, is this ownership magic, which can make such a difference to the way the bank runs and to the fun of being an employee in that company. So I think I'll leave it there. I'll hand back to you, but thanks very much for your attention. I hope that was entertaining. Thank you.